Hey everyone, what's up? George here from the Millionaire Project. Thank you guys for tuning in once again. If you watched our last video, we mentioned that we were going to be coming out with another video talking about some of the top picks that we have for this year. So these are just going to be some names that we personally believe are going to have a promising future this year and carrying on into the future years from now. We're going to be taking positions in them to trade, as well as taking a longer term investment position in these companies. So to start off here, let's just kind of go over and give you guys a little recap of the market, just in case you didn't watch the last video or if you just don't remember where we are. So 2021 was a great year all around, particularly for tech. You see, tech just absolutely killed it. You can see here the S&P 500 just rallied endlessly last year, fueled by tech, just nonstop growth for a lot of tech names. And now we're sort of hitting a point where tech is starting to pull back. So a lot of people are starting to see that a lot of these companies are overvalued at the levels they're currently at, and they're starting to take their profits and put them into different positions. A lot of people, they see this and they think that the market is starting to crash, but the market is not crashing. The market is actually giving you a very good opportunity to put your capital into other names that are going to be rotating some of this capital. This is just how markets work. They go from overbought sectors and areas in the market, and they start going into underperforming areas. So what are these underperforming areas? Well, for one, we have a lot of our leisure and travel stocks down here. So BA, for example, is just a heavily underperforming name in 2021. If you see, they're trading well below their pre-pandemic levels. If we take a look at that right now, they were at 400 plus pre-pandemic, and for most of the year here, they've actually been downtrending. So we're going to start seeing some capital flowing into names like this. You have your leisure and travel stocks, and then you have a lot of value names that just could not see the light of day last year because of how strong tech was. And now a lot of these names, a lot of these small and mid-cap names are going to start seeing a lot of growth. So with that being said, a lot of people just focus on tech stocks the most, and unfortunately, because of that, they see tech is coming down, so they just automatically assume and think that the market is crashing and they start to panic. However, the market is not crashing. You just need to change your strategy and look for other opportunities that are actually going to give you a boost. You're going to be able to take advantage of them. So let's go ahead and take a look at the list and start off by going over some of these names. Alright, so this list, like I said, these are just some ideas and picks that we personally believe are going to do well here over the next year and leading into the following years. So as you can see, we have the company ticker symbol, a little bit about the company, performance and strength rating. So these ratings here are 1 through 10, 10 being the strongest, and they're really based off of these 6 points here that I've made. So the overall outlook of the stock sector performance this year, their debt to asset ratio, the cash flow and revenue that the company is bringing in, their potential to grow based on how much they're spending for research and development of the company, where they currently stand in the market. So if you see here, you can see that a lot of these names are still in the tech sector. So we mentioned that tech is pulling back. So we're going to talk about this once we get into the companies and just the overall strong fundamentals. A lot of these companies have some very strong fundamentals, so they're going to be good pickups regardless. But these are the 6 categories that we're using to base this off of. And then here you just have the sector the company is in. So first off on the list, we have Apple. So we mentioned that tech is pulling back, and we're starting to see capital rotate from tech into other sectors. So you may ask, why is tech on this list here, and why is there so much tech still on our list? Well, the fact of the matter remains that tech is a very dominant sector, and no matter what happens, tech is just going to continue to grow. So from here on out, all of these companies, Apple, AMD, Amazon, Meta, Microsoft, all of these companies, they're going to continue to grow. This is just how we are. We're in a very tech-dominant world, and these companies are going to continue to grow. None of these companies are going to go down and stay down. They're simply going to see pullbacks, and if you take advantage of these pullbacks, you could see some very nice returns in the future. So first on the list, Apple. Obviously, Apple has a very consistent consumer base. They have a lot of technology that they've integrated into our everyday lives. So, a lot of people use iPhones, laptops, everything that is an Apple product. So people use them every single day, and they're only going to continue using them more and more. Another point here is that they had hit $1 trillion valuation. Obviously, this was prior to them pulling back, but the point here with this is that it shows you how much people view this company as having potential and where we see it going in the future, that it was able to hit such a high valuation. So looking at Apple on the chart, you can see that they just had a consistent rally all year long, really nonstop. They just continued to grow, and it was a very strong company. And towards the top here, we're starting to see a pullback. So Apple is a great company. We have it on our list, but do we want to get into Apple at these levels here? Of course not. We mentioned that these are very high levels, and if you see, it is not too far off from an all-time high. So what are we wanting here? We want to see Apple come down, and if you watched our last video, we mentioned that you could see a lot of these tech names starting to pull down around their 100 and 200 day moving averages here. So Apple, it's not going to be very unlikely that we start to see Apple around the $150 range. If we get down to that point, you would be crazy not to add Apple at $150 after seeing what it has done here, and it's giving you that great opportunity. So we're going to be waiting for Apple to hit a pullback before we enter this position, but this is going to be one of the companies on our list. So next on the list is Airbnb. So Airbnb is very dominant in their field, and the reason for this is because when you really look at it, they have no direct competition. They're sort of a lone wolf in what they do and in their own sort of field. So they're leaders, and they just do not have any real competitors. All right, so if we look at the chart, you can see Airbnb has sort of been a roller coaster, to say the least. So the company is trading well below its highs here. They started to pull back, and when we had fears of the Delta and Omicron cases rising again, obviously a lot of these travel and leisure stock names took a hit, Airbnb being one of them, benefiting quite a bit from travel. And in their recent earnings that they reported, they mentioned that they did take a hit from 2020 and going into 2021. They started to recover a bit, but I believe revenue is down almost $30 billion. So looking at Airbnb, we can see here that they've hit another high and they've started to come down and downtrend again. So what does this mean? We mentioned that a lot of these leisure and travel stocks are going to start seeing capital flow into them once again. So Airbnb is currently around their 200-day moving average line, and they've been bouncing at it. So this would be a pretty good pickup here to add on Airbnb. Going into 2022, as we ease out of this pandemic, you can only see companies like this starting to grow and approaching these highs once again. So adding Airbnb here is going to be a really good price, and you could start off small. You could start off with a smaller position, and if you happen to get a further pullback, you can add on that pullback. But the stock is trading right around its 200-day moving average, which is typically the buy the dip mentality that investors get around this level. So we could see Airbnb start to reverse here and go back up. The other thing is that looking at Airbnb as a company, obviously they're going to be very profitable in the future once the pandemic starts to ease, and it's just a cheaper and more convenient thing for a lot of people to do, comparing it to hotels in many cases. You know, a lot of people as of late, you know, they may just want to go to a vacation and get their own house to stay at, or, you know, get their own condo or something to stay at rather than going to a hotel, and Airbnb makes that very convenient. Personally, I have not used too many Airbnbs. I have used a few, and I have noticed that some of the prices are actually cheaper than what it would be getting a hotel, and I've had no complaints. I've actually had a great experience. The hosts were all great. So yeah, Airbnb, great company going into 2022. Next up on the list, another tech name, AMD. Obviously, AMD is a semiconductor company. They use chips. So Meta is going to be using the AMD chips. Obviously, they have been impacted by the chip shortage, and we've seen some strong growth from this company. So let's take a look at them on the chart. So looking at AMD on the chart, again, you can see another massive rally from here. As we said, tech had a great and just huge rally, and AMD was part of that. Looking at AMD's future, the company does look very promising. So AMD, again, is starting to pull back here. Not very unlikely that we see AMD come back down to these $100 to $110 levels. This would be where you'd want to pick the stock up at here. at this level, it's right around the 100-day moving average. So could you add? Yes, you could start a position adding here. However, you are likely to get a further pullback coming down a little bit more that is going to give you a better opportunity. So we're going to start seeing these companies producing chips again, and they're going to start being a lot more profitable. All right, next up on the list is Amazon. So Amazon is just a great company. It's the only one on this list that got a perfect 10 rating. There's really nothing bad to say about Amazon. You look at a $70 billion revenue company, great numbers all around. Just a great company. They're only going to continue to grow. They're leaders in the e-commerce industry. And looking at this year, they've still been impacted by the pandemic, and they've still killed it in terms of numbers. So let's look at the chart. When you look at Amazon's chart, something you notice here is that they really have not grown too much. So if you bought Amazon sort of at the beginning of 2021, you probably haven't made that much money on it, if any at all. So Amazon has just been hugely underperforming in 2021, and this just makes no sense because it should have rallied. When you look at companies like Apple, you see these huge rallies that it had. You look at Meta, which was formerly Facebook, huge rallies here. Amazon just did not get that. So something to note is that look at Amazon's pattern here that you see on the chart. So Amazon has sort of been trading in this sideways pattern, and they've started coming down here towards the end. So let's go ahead and take a look at Apple's chart. So looking at Apple's chart, what do we see? We see that Apple had a very similar sideways pattern here, and as soon as they started to come down, what do you notice? You see they had a huge influx of buyers come in that led to this massive rally that they had. So this is almost an identical pattern that we're seeing on Amazon here. If you look at the chart, you can see they're starting to come down, and it's not going to be unlikely that we see a very similar pattern happen to Apple, where they start getting some buyers and they start to really take off. Amazon is just, they're not going anywhere. The company is only going to continue to grow. The stock is only going to continue to grow. The stock is not going to keep falling. People are not going to leave Amazon at these prices here. They're going to start buying it up. And once they do, it's really going to start taking off and rallying, just as Apple, Microsoft, and all these other tech companies did. Another thing to note is that a lot of these companies, Amazon, for example, you see here they're $3,242 a share. So a lot of people get turned off by this because they simply don't want to put that much capital into a stock. So when we're talking about getting into Amazon, it's okay if you can only get into one share. When we're talking about buying, the average investor, is not going to have hundreds of thousands of dollars to invest into their stock. So when you look at Amazon, if you can only buy one share, that's perfectly fine. There's nothing wrong with that. They're expensive, but these companies, Amazon, Google, even looking at, cheaper companies such as Apple, for example, a lot of people still do get turned off by that sub $200 price. So $150 to $200, is still a pretty expensive stock price, and a lot of people do not want to buy that. They want to put their capital into cheaper names, sometimes even penny stocks. So looking at something like this, you want to get into names like this. When you're starting to build your longer term portfolio, you want to have fundamentals come in first when you're looking at it. So you want to have stable companies like your Amazon, your Apple, your Microsoft. You want to have companies that are going to be here in 10 years and are only going to continue to grow. So if you can only get one share, get one share. Put that $3,000 into Amazon, and the company, it's expensive, but it's going to split. They're gonna have buybacks. You're gonna start to get some more money coming into this stock here, and it's just a safer bet. So a lot of people would rather take this $3,000 and put it into their like a Neil. That's a $30 stock here, but really, that's a very high-risk position. So you're going to get a lot more shares, and it's going to be a higher reward if the company does come up. However, that is a big if. With something like Amazon, you should be very comfortable with putting your money into the stock and not having to worry about losing it or having to even stress about it at all. All right, next on the list is Boeing. So obviously, Boeing was impacted by the pandemic, and currently at these levels, they're very low and attractive. Let's take a look at it on the chart. So when we look at Boeing, you can see they're currently trading at $225. This range right around here was the pandemic. You could see they fell, and pre-pandemic they had reached the price of $446 a share. So they're trading well below their pre-pandemic levels. This is a very low and attractive price. The stock it simply has not fully recovered. You can see since the pandemic it has started coming up, and it's been in a consistent uptrend. And as we mentioned, it's going to start to see some capital rotate into it this year. A lot of these travel and leisure companies are going to start getting money rotating from tech, and they're going to start coming back up towards these levels. Obviously, Boeing is a leader in airlines. They make the majority of planes. And we just mentioned that they've been impacted by the pandemic in terms of both revenue and in terms of how they can function as a company. So they've had to make a lot of adjustments that does hurt their revenue, but they're still going to continue to adjust and make more money. And as we start to ease out of the pandemic, they're going to start making more and more money. All right, next up on the list here is Disney. Disney, there really isn't much that needs to be said about Disney. Disney is just a clear choice. They're a safe company. They own ESPN, they own Fox, they have Disney Plus. The parks are open now. They're just bringing in some nonstop revenue from both, the parks and as well as ESPN, Fox, Disney Plus, just consistent flow of capital coming in. And when we look at the chart, when we look at Disney's chart here, my God, look at this right here. They're floating just right around their 200-day moving average. You'd be crazy to not pick them up around these levels if you don't own any Disney in your portfolio, let alone if you do. This would be a great pickup around these levels here. Disney is just, that is a company that is not going to go anywhere anytime soon, especially as of late now. They've been doing a lot with Star Wars. They're only going to start coming out with more and more TV shows that are going to be attracting more and more audiences, which means they're going to be bringing in more revenue. Then you have, a lot of other TV shows, Marvel, just all these shows on Disney Plus that are just bringing in revenue and catching, views after views. And Disney is you can think of it as also a hedge type of position. So currently in the market, like we just said, a lot of tech is coming down. So when a lot of investors see that tech is coming down, you have your safe haven stocks, which is typically your precious metals like gold and silver. But Disney also acts as one of these companies as a sort of safe haven. So if we start seeing these companies come down, you could start seeing a lot of capital flow into Disney. And, just seeing Disney at these levels here from their highs that they were at and where we're currently at in the pandemic, like I said, you'd be crazy to not pick up Disney. This is definitely one of my favorite picks on the list. And if you check it out, they actually did get a 9.5. Next up is Ford. So Ford, again, another pretty safe stock to say the least. So we originally added Ford in our portfolios almost 2 years ago. And since then, they have tripled. So looking at the stock, you can see it used to be a very cheap stock around, at the low, it hit just under $4, but, the stock used to float around $8 to $10, and since then, they have tripled and went above and beyond. We added them into our position, like I said, about almost 2 years ago, and we still love them at these levels. They're only going to continue to grow as well as they're expanding into the EV sector now. They own part of Rivian, if you guys didn't know that, and they're going to be a clear competitor in the EV sector. They're fundamentally and financially strong. And you may ask, if you look at the list, why didn't Tesla make the list? Why didn't, Lucid make the list? The reason they did not make the list is because they're simply not mature enough yet. When you look at a company like Ford, Ford has been around for a while and they have been bringing in consistent revenue. When you look at Tesla, yes, Tesla has rallied very massively and they're only going to continue to do so. However, looking at the financial side of it, Tesla only just now recently became profitable. So that is something to think about. And then when you're looking at a lot of these other EV companies like Lucid, you have your NIO, Rivian, a lot of EV companies are not going to make it. You're only going to have your strong companies that have already made a name in the automotive industry and are only going to continue to grow. So Ford is a strong staple, and you have Ford, you have GM, that is another good pick. They did not make the list simply because we like Ford more, because we see a bit more growth potential. And when you look at the financials, Ford has a lot more revenue than GM given their price in the market. Ford is around $22 and GM is around 50, I believe, 56. So, given the financials, Ford is they're a clear pick to us. However, going back and looking at Ford's chart, like we said, you see they have had a massive rally. And today was actually, the market came down. We pulled back today. We're approaching earnings, so a lot of investors are just hesitant about that. They don't really know which direction we're going to pick. However, Ford is a great pick, but just like with Apple, you wouldn't want to add Ford at these tops here. You want to give it some breathing room. You want to let it come down and retest some of these support points that it's made now, and you want it to come back down to some of these moving average lines. So do you want to add Ford here at $22? I mean, go ahead. We do see this name growing quite a bit in the future, well into the 30s and 40s. However, you will get a much better entry if you wait for it to come down, to your 50-day moving average line or your 100-day moving average line, because it will. Every stock is going to have a pullback just as capital rotates. Next up is Meta platform. So Meta used to be Facebook, for those of you who don't know. Again, another tech play here. We said tech is going to be very strong, and Meta is a very strong company. So one of the big things that they have going for them right now is their metaverse expansion. So let's go ahead and take a look at the chart. So once again, looking back at the year, you can see they have just had a massive rally, just like with every other tech stock. And like we just said, they have the metaverse expansion. So the metaverse is projected to be very big in the future. We personally here do have a few metaverse plays, and we are going to be keeping an eye on it. And Meta is a big leader in that space. The other thing is, they own IG, and today they actually came out with some news regarding IG, which may allow them to be more profitable. And just looking at their future, this is a type of company that is only going to gain more contracts and partnerships and continue to grow. Next up is Microsoft. Again, another tech name. Let's go ahead and look at the chart. So once again, just like with the rest of tech, Microsoft rallied up to these highs. And if you actually see here, they have sort of started to underperform lately. So they're actually, currently they fell below their 20-day moving average line. You can see here that they attempted to make a push above it, but got rejected, and they're coming down. So the next likely support point that they will hit is going to be the 50-day moving average line. And this is going to be a pretty good position to add. This is already a good position to start, in my opinion. However, you are probably going to get a little bit more downside here as tech continues to fall towards the 50-day and maybe even towards the 100-day moving average line. Great company overall, financially and fundamentally sound, and they have a lot going for them, with growing tech and as well as the metaverse expansion. Next up is Intel. So a chip stock. So they've showed some very strong growth, and obviously they were impacted by the chip shortage. And this is going to be one of our favorite chip plays. So as you can see here, we also put AMD and NVIDIA here, but they did not actually make it to the list, and I'm going to explain why once we get to the chart. So when you look at the chart, you can see that over the past year, Intel has really not grown at all. They've just kind of been on this little roller coaster here. However, if we take a look at something like AMD, you can see they had a very strong rally along with the rest of tech. And then we take a look at NVIDIA, and you can see NVIDIA had a very strong rally as well. So you may think to yourself, all three of these companies are in the chip sector. They all basically do the same thing. So why are all these rallying like this and at such high prices, yet Intel is not? And that is exactly why we like Intel. This is a very clear choice here when you're looking at the chip sector. You can see Intel is highly underperforming compared to its competitors, even though it is a much more fundamentally sound company. So they have better revenue, they've been around longer, and they have a much better debt to asset ratio. So I believe Intel, in terms of their financials, they have a $230 billion valuation, whereas AMD, I believe, has a $160 billion valuation. Actually, let me go ahead and check that for you guys right now. So let me show you how you do that as well. You can go to tradingview.com. This is another site that we love to chart on. And then you would just type in the ticker. Once you get to it here, you want to scroll down to the financials. Click on this here, and we could take a look. So their total revenue was $78 billion. So we see this here at $78 billion, and the stock is $53 a share. So let's take a look at AMD. When we look at AMD, you could see their revenue was just under $10 billion, yet when we look at the stock price, you can see that AMD is trading at $128 a share, hitting a high of $164. Much higher than Intel, and it just doesn't make any sense because you can see Intel has, almost 10 times the revenue that AMD has had. So it makes no sense that Intel is trading at these low levels here. When you see Intel, they have a high of $69. That just makes no sense with how profitable they are. So once investors start to pick up on this and they start to see this rotation actually taking place, we could start to see a similar move from Intel like we've seen from their competitors, like NVIDIA and AMD. So this is a very attractive company. All right, next up is Roblox. So if you've been following us for a little bit, you know that we have been talking about Roblox ever since they IPO'd. We typically do not like IPOs. However, Roblox was an exception. So clear here, again, another metaverse play, arguably the biggest metaverse play. They've shown some very strong growth numbers, and again, they have very attractive financials. So let's take a look at the chart. So like we said, this is a metaverse play. And when you look at Roblox, you can see that their numbers show that they've had some very strong growth. So this is in terms of revenue as well as in terms of daily users. So this is a big thing for companies like this that provide a online gaming service such as this. You want to see how are they growing, not only annually, but you want to see how consistent is it on a day-to-day basis. Are they losing streaming and gaming numbers, or are they continuously growing? And we could see that from Roblox, they're clearly growing and advancing and putting more and more money into the company to only make it better. Looking at the chart, you can see that it's sort of inconsistent here. They reported earnings and they were actually great. So that led to a huge spike in the stock, more than doubled. And since then, they've started to come down a bit. And with the market downturn here, they've actually started to come down a lot and broke below their 200-day moving average and are currently trading below it. Looking at some of the indicators here, you can see that it's approaching a oversold position and the MACD looks like it could cross up any moment now. So in my personal opinion, this would also be another very good add for Roblox here. Again, the way you could do this is you could start off with adding a small position, and if you get a further pullback, you can add more on that. But, this is a pretty good example here of what you want to see from some companies. Yes, this is a little bit more selling than what I would like, but given the current market condition that we're at, Roblox is just one of those names that got caught up in the overvalued position and has just continued to sell off now. However, looking at the numbers, you should feel very confident in Roblox. By no means should you have, a huge position in this company like you would in, your Apples or Amazons. However, this is worth a smaller position. But going back to what I was saying, this is kind of what you want to see from some of these companies that rallied. So, your Apples, your Fords, all this, that we're at these highs, you want to see them start coming down towards these levels here. And this is where you want to start adding, So once Roblox broke below the 50-day moving average and started using the 100-day as support here and they were bouncing around, it would not be a bad idea to add a small position here. And if you get that break further down, you could add on these dips. Next up on the list is Uber. So this is another company that obviously you don't want to put all of your capital into, but it is worth a small higher risk position. So if you see our rating, we gave it a 5 and we're going to explain why. We said that this rating is improving. However, when you look at Uber, you can see that they clearly underperformed due to COVID. They just, they lost a lot of revenue from that. But overall, they have had some good financials. And when you look at it, they are starting to move towards profitability. This is the main reason that they got a 5 is because they aren't actually profitable yet. And, with COVID hurting them, that only decreased this value a bit. But they are moving towards profitability. So this number is going to improve, to a 7 or 8. So looking at the chart, like we said, major thing is that, their profits have not been consistent, but they have been moving more so towards profitability. And looking back there, you can see that Uber is one of those companies that we mentioned they have been underperforming. So we could start to see them bottoming out here. And as money comes out of tech, we could start seeing it going into some names like this. But overall, pretty good company. You know, they have Uber Eats, and then you obviously have your traditional Uber. People are just going to continue using that, and in the future, we are probably going to have more and more advancements that are only going to lead to people using companies like this more. And the other obvious reason is at these low prices here, this is a very attractive price. But like I said, do not overload your portfolio with this position. You know, it's good for a small, higher risk position, but, you know, comparing it to these highs that it had here at 64, this is a very low and good price to add. And looking at the moving averages, you can see that it's below, so we can expect a bounce sometime soon here. This is also a pretty good point that I wanted to bring up here, is that look at these moving average lines and you can see how close they are, how tight knit together they are. And then when you compare it to something like Apple, for example, you can see that Apple's moving average lines are much more spread apart. And the reason for this is because of the different spikes in price. So Apple obviously is a lot more expensive per share, so it's going to have a bigger jump every single day than what Uber would have. So that gives it these big ranges between their moving average lines. So when you see certain stocks having very tight-knit moving average lines, that's just because they don't have a lot of volatility in their name. They're a very low volatile stock, whereas something like Apple is high volatile. You know, you see today it dropped $3.57, whereas if we look at Uber, you can see Uber only had a 55-cent drop. However, it's only about a 1% difference in price change. And for Uber, a 55-cent drop is much more dramatic than a 55-cent drop for Apple. So that's the only reason why moving average lines can look different sometimes. I just figured that was a pretty good point to bring up here in case any of you were wondering. And then the last two companies on the list here are actually REITs. So REITs are real estate investment trusts. The reason we added REITs is because, in my personal opinion, I think 2022 is going to be a good year for REITs, simply because when you look at the overall market, we aren't really trending in a specific direction. So with a REIT, you obviously have a guaranteed return amount. This is typically around 5 to 8%. But the other thing that I like about REITs right now is that a lot of them are still below their 2020 to 2021 values. So when we look at the charts, you can see that a lot of them have just had a very consistent uptrend. However, towards the end of 2021 here, they started to fall as we started getting news of the interest rate hikes. So they're starting to come down. IRM in particular is right at the 50-day moving average line. So we can either expect one of two things, which is going to be a bounce to continue to move up to break this 20-day moving average to continue moving up towards these new highs, or a break below that will take it most likely down to the 100-day moving average. This is the weekly candle, so when we look at the daily, we actually can see that they're probably well below their 200-day moving, and sure enough, they broke below the 200-day moving average line today. They were bouncing around it, so we can definitely expect a bounce from IRM sometime soon here. But again, this is another perfect level to add a company like this. They're at their lows, and when you have a guaranteed return like that, these are just good opportunities to pick up positions and hold them for a while. You know, these companies, they just seen huge growth last year. And the other good thing about them is that a lot of them have dividends. IRM in particular has a very nice dividend compared to most other REITs. I believe it is $2.47 a share. And we have added IRM in our portfolio almost 2 years ago. So they've doubled since we've added them, and they've only continued to see growth. And we're going to be adding again pretty soon here. But yeah, overall, you know, this is just a list that we came up with. Again, in no way, shape, or form am I recommending that you get into any of these names. We're not financial advisors here. However, these are just some companies that we're looking at that we believe are going to have a promising future. That's pretty much it. That's all I got for you guys today. Hope you guys enjoyed the video. Give us a like and subscribe to the channel for more. And yeah, have a good one.